Hey everyone, and welcome back to another explainer. So, have you ever stopped to wonder where the modern Forex market actually came from? Because today we're going to trace an absolutely incredible journey. We'll look at how global currency trading evolved from literally the humblest beginnings you can imagine into the absolute titan of a financial system that it is today.
Okay, let's dive right into this. Did people always trade currencies the way we do today? Well, obviously not, right? I want you to picture a world before digital screens, before central banks, or before the concept of money even existed. Human trade had to rely on some really primitive systems just to get things done. So, to truly grasp the mechanics of our modern market, we've got to look at the historical friction that literally forced it into existence.
But before we hit rewind and jump backward in time, let's just establish the sheer, mind-blowing scale of our modern reality. $7.5 trillion. That is the jaw-dropping volume exchanged in the global Forex market every single day. Trillions of dollars, continuously moving around the globe. It's almost incomprehensible, right? Try to keep that massive liquidity in the back of your head as we look at exactly how humanity arrived at this point.
All right, Section 1, the physical era, moving from barter to gold. So way back, long before money existed, societies relied entirely on the barter system. But it had a fatal flaw. Economists call it the double coincidence of wants. Basically, if a farmer wants fish, but the fisherman doesn't want rice, well, the trade just stalls out entirely. It was clunky, highly illiquid, and scaling any sort of meaningful economy this way was basically impossible. You couldn't exactly chop a fish up into tiny fractions to pay for a handful of grain, right? Plus, storing wealth long-term was completely out of the question. People desperately needed a universally accepted medium of exchange.
And that exact friction? That's what led to the invention of money as an intermediary. It started off with precious metals like gold and silver, which eventually evolved into coins and paper money issued by specific nations. Problem solved, right? Well, actually, solving domestic trade created a totally new international hurdle. Merchants now needed a way to exchange one kingdom's currency for another, and this is exactly where the roots of foreign exchange were planted. Suddenly, you had this massive need for liquidity between different regions, meaning early brokers had to literally assess the weight and purity of foreign coins just to make basic cross-border trade happen.
Fast forward a bit to the late 1800s and we hit a major milestone, the gold standard. Basically, a country's currency became backed by a fixed physical amount of gold. Governments were essentially guaranteeing that you could walk in and exchange their paper money directly for a specific weight of that precious metal. And honestly, this was a brilliant move for international trade. It created immense confidence and stability in currency values across borders. But it definitely wasn't perfect. Tying money directly to a physical commodity severely limited how central banks could manage their own monetary policy, and that became a glaring issue whenever a financial crisis hit and they desperately needed some flexibility or added liquidity.
Let's move on to Section 2 and see how this builds into the institutional era, going from Bretton Woods to fiat currency.
Picture the world right after the devastation of World War II. Everything is in ruins, and world leaders desperately needed a stable, highly reliable monetary system to rebuild global trade. Their solution? The Bretton Woods System of 1944. Representatives from 44 different countries got together and hammered out this groundbreaking agreement. Instead of every individual currency being tied directly to gold, these nations agreed to fix their exchange rates to the US dollar. Why? Because the dollar was, at that point, the only currency still backed directly by gold. It ingeniously anchored global trade, provided much-needed stability for decades, and firmly established the US dollar as the world's primary reserve currency.
Taking a step back to look at this macro timeline, it's a pretty incredible journey. We started way back in ancient times with that highly illiquid barter system. We solved that, which eventually led to the gold standard of the late 1800s, providing confidence, sure, but limiting economic flexibility. Then, out of the ashes of war, we get the stabilizing Bretton Woods System in 1944. Each era naturally evolved to solve the fundamental economic flaws of the previous one. But as we approached the early 1970s, the economic landscape shifted all over again, and governments were finding it increasingly difficult to maintain those artificially fixed exchange rates.
So, the crucial point here happens in 1971. This was a monumental shift, often called the Nixon shock. The United States officially ended the direct convertibility of the US dollar to gold. The old system had simply become unsustainable, mainly because global dollar reserves completely dwarfed the actual US gold supply. Governments stopped artificially fixing rates, and shortly after, they just allowed their currencies to float freely. Suddenly, currency prices weren't dictated by some fixed gold promise anymore.
They were determined entirely by global supply and demand. And guys, this was the official birth of the modern, free-floating Forex market. Which brings us right into Section 3, the digital era, where technology finally meets the retail trader.
And this brilliantly illustrates how things totally flipped. In the early years of this free-floating market, it was essentially an exclusive closed club. Currency trading was completely locked down, restricted mainly to central banks, commercial banks, and massive financial institutions. But then, the internet completely changed the game. The rise of online trading platforms opened the floodgates. It meant that an individual sitting in their living room, literally anywhere in the world, with just a computer and an internet connection, could suddenly tap directly into the global market alongside the institutional heavyweights.
And because of that digital connectivity, the modern Forex market never sleeps. It operates continuously, 24 hours a day, 5 days a week. It rolls seamlessly across major financial hubs, from Sydney straight to Tokyo, over to London, and then New York. It is a fast-paced, relentless, completely interconnected global web. It provides unparalleled liquidity and officially stands as the largest and most actively traded financial market in the entire world.
So who exactly is in this market today? Well, it's a massive, diverse ecosystem. You've got central banks actively managing national monetary policy, commercial banks facilitating cross-border trade, hedge funds out there seeking yield, multinational companies hedging their operational costs, and, of course, millions of retail traders. Together, this dynamic network exchanges those trillions of dollars every single day, causing currencies to constantly fluctuate based on a continuous stream of economic data, shifting interest rates, and evolving market sentiment.
All right, Section 4, the so what? Why does all this Forex history actually matter to us today?
You might be wondering, why even bother tracing this path from farmers swapping rice all the way up to digital high-frequency transactions? Well, because learning the past gives you a much stronger foundation for understanding the present market. Exchange rates today are influenced by central bank policies and structural economic shifts, exactly as they have been for centuries. The wild fluctuations you see on today's charts, they're driven by the exact same human need for efficient liquid exchange that drove the creation of ancient coins and the gold standard.
So we know the monumental history that built this arena. But the big trillion-dollar question remains. Who is actually moving the market right now? How do these major players pull the strings on those trillions of dollars, and what data are they watching to do it? Well, that is exactly what we'll be unpacking next. Make sure to hit subscribe, turn on notifications, and join us for the next explainer where we break down the modern market's absolute biggest movers. Thanks for hanging out with me, and I'll catch you in the next one.